Welcome to Tech Frontiers, the definitive podcast for navigating the ever-evolving landscape of technology and innovation. I am your host, Pierre Beunardeau. I am the co-founder and the CEO of Galileo Protocol, developing the NFT standard, physical non-fungible, guaranteeing the provenance and the ownership of physical and luxury items thanks to the blockchain and the AI. And today we have a lineup that is packed with amazing updates and important news. We will kick things off with Caroline Ellison case, a secret recording that uncovers shocking news that could have big impact on the tech world. Then we will debunk the myth that NFTs are dead, and far from it, we will talk about why they are just in a quiet period and what's next for this type of online property. Moving on, we will delve into the involvement of top brands in Web3, NFT and the Metaverse. Why and with these heavyweights stepping into the arena, what does it mean for the broader digital ecosystem? Next, we will examine the SEC decision not to appeal in the Grayscale case and what this could mean for GBTC becoming a Bitcoin ETF. Could this set a precedent for the cryptocurrency market? And lastly, we will look at Ferrari groundbreaking decision to accept cryptocurrency as payment for its cars in the United States. How is this shaping the interaction between luxury brands and digital currencies? So first, we are going to talk about Caroline Ellison and the secret recordings offers truth of explosive revelation, and the article presented raise several points that are crucial to understand the situation surrounding FTX, but also Alameda Research and the implicated individual like Caroline Ellison and Sam Bankman-Fried. The first problem that it is outlined in this article, it's about the access to the customer funds and what are the implications. Because in the traditional finance, we have stringent rules concerning who can access customer funds, and there are firewalls, both literal and regulatory, that prevent one division of a company or a related company from freely utilizing the funds of others. And these rules serve to protect consumer interests, but also maintain the integrity of the financial system and prevent potential conflict or of interest or fraud. And it's about also bad investments, because the fact that Caroline Ellison openly admitted to making bad loans indicates multiple layers of systemic failure within the company. First, it suggests that the risk management procedures were either inadequate or missing, and the consequences of these bad investments not only impacted Alameda but also shook the financial stability of the centralized exchange, FTX, and this could also signify a severe lack of transparency, and investors and users are typically shielded from such risky business decision, and this type of loans should never have been made using customer funds without explicit consent or legal leeway. And they plan to raise more funds where a business is facing financial turmoil. It often resorts to emergency fundraising, and FTX plans to do this reveals that they were at least aware of the gravity of the situation. And however, the failure to secure additional investment is telling. These failures implies the potential investor either lacked confidence in FTX management or was scared off by the company financial debacle. And furthermore, this leaves us wondering how FTX intended to make their users financially whole. Were there any backup plans? But it's also about market manipulation, because if the allegations of market manipulation are true, they could have profound legal repercussions. Utilizing customer funds to manipulate the market is not just unethical, it's also likely illegal. And such an action will be a breach of fiduciary duty at the least and could lead to federal criminal charges. And SBF instruction to Ellison, the CEO of Alameda, to sell Bitcoin above a certain price, 20K, using customer funds, raise questions about the integrity of both FTX and Alameda Research. And it would have an impact on Bitcoin price, because the role of FTX played in the potential suppression of Bitcoin prices adds another dimension to the unfolding scandal. If these claims are substantiated, it implies that the activities of one exchange and its affiliates can have a broader economic impact on the decentralized currency, and this will not only affect FTX but the entire crypto market, leading to question about the resilience and integrity of this crypto ecosystem. And the different press releases that I've read fall out from this and cannot be overstated. Trust, once lost, is difficult to regain, and especially in a space like cryptocurrency, where trust is already a highly valued commodity. And this trial and its revelation could serve as a lightning rod for public opinion against not just FTX and Alameda, but potentially the entire crypto industry. And regulatory bodies could also use this as a case to usher in stricter regulation, changing the landscape of crypto trading and investments. The question is, could this scandal have been avoided with more stringent regulation in place for the crypto companies? I think the case we mentioned indeed spotlight the challenges of governance, transparency, and regulatory oversight in the cryptocurrency industry. And while it's difficult to say definitely whether more stringent regulation would have prevented this particular scandal, there are some key points to consider. The first one is the regulatory clarity, because a clear and comprehensive regulation could provide companies with specific guidelines on what is and isn't permissible, potentially reducing the chance for malfeasance. And after regulatory clarity, oversight and auditing, because regular oversight by regulatory bodies and third-party audits could ensure that companies are complying with regulation and best practices, which might deter bad behavior. And finally, it's about the transparency, because stringent regulations might require a higher level of disclosure and transparency from crypto companies, making it easier from both regulators and the public to identify suspicious activities. And speaking of explosive revelation, let's shift our focus to another topic that has seen its share of ups and downs. The NFTs, are they really dead, or is it just a part of their life cycle? So we are going to read this article. So this article is talking about an NFT winter. The term NFT winter or crypto winter has become a buzzword to capture the lull in the NFT market, and media outlets have been quick to declare NFTs as worthless and dead. I think it's essential to note that such extreme views often arise in volatile emergent markets, and the declining trading volume are a noteworthy point of concern, but not necessarily a death sentence for the asset class. There is an high failure rates, and this is not new. I mean, historically, ICOs and DeFi tokens also faced high failure rates. It's a recurring theme in a new financial market undergoing rapid experimentation, and the idea is not to view the failure as an endpoint, but as a cycle in a longer journey. And lessons from these failures often serve as stepping stones for a more resilient system and structures. And there are barriers to entry, because one of the key factors contributing to the NFT market slump is the low barrier to entry. And while this encourages innovation, it has led to a flood and low quality projects that failed to add real value. However, this could be a double-edged sword. In the long term, it may result in a Darwinian landscape where only quality projects thrive, improving the overall credibility of the NFT market. And we are seeing more and more mainstream collaboration, because even in this so-called winter, significant developments have taken place. PayPal entry with a patent application, collaboration between brands like Crocs and NFT project and mainstream artists like Justin Bieber and Harry Styles entering the arena are all signals that NFTs are far from dormant. And this partnership also serves as a real-world utility and acceptance indicator for NFTs. What is the future? The article wraps up an optimistic note suggesting that NFTs are poised to become more redefined and commercially viable. It indicates that the ecosystem will likely shed its speculative skin to take on more utilitarian role in the near future. So it might be premature to eulogize the entire market just yet. And after dissecting why NFTs are far from being a dying trend, it's time to dive into another pressing topic. Today, we are also looking at how globally renowned brands are not only entering but thriving in the world of Web3, NFT, and Metaverse, even amid the financial setbacks of crypto winter. And the first big player is Nike. Let's start with Nike, a brand that has always been on the cutting edge of innovation. Not content to merely dip their toes in the Web3 waters, they are plunged headfirst by acquiring NFT sneaker studio RTFKT Studios, and this acquisition allows Nike to produce a Metaverse sneakers line blending two boundaries between the digital and the physical world. Even more intriguing is their move to grant commercial rights to clone X NFT holders, and this is a game changer, offering a new business model that could reshape the way brands interact with their audience. And we have Dolce & Gabbana also. Moving on to the luxury fashion sector, these brands unveiled the collection Collezione Genesi, sorry for my Italian, an NFT collection that includes items like the Impossible Tiara, adorned with diamonds and red emeralds, fetching a whopping 6.65 million. This collection is evidence that the luxury market is ripe for digital disruption, and Dolce & Gabbana has not stopped here. They have also introduced DG Family, an NFT community aimed at bringing digital luxury and culture into a single platform. We have Tiffany & Co. also. If you think that the only newer brands are into these trends, think again. Tiffany & Co. is also offering a nostalgic yet modern twist with exclusive NFT necklace available on the CryptoPunk holders, and this NFT can be redeemed for real diamond encrusted necklaces, representing a novel convergence between digital assets and the physical luxury goods. Finally, Gucci Web3 strategy is a complex web of initiative, and from NFT to Metaverse real estate, they are starting by turning their Aria fashion collection into an NFT video, followed by collaboration with toy brand Super Plastic. As they can even have a redemption model where NFT can be swapped for physical ceramic sculptures, providing a tactile dimension to digital ownership. So what we see here is not just adoption but innovation, and brands are making calculated, disruptive moves, proving that the interaction of traditional businesses with Web3 has moved behind experimentation, and it's a full-blown frontier of opportunities, merging the digital and the tangible in ways we've never seen before. And given the aggressive move by big brands, what do I think it will be the next big innovation in the web space? I think the convergence of traditional business and Web3 is indeed creating a dynamic frontiers ripe with opportunities for innovation. And based on the current trends, there are several areas where the next big innovation could emerge in the Web3 space. We have the DeFi. As big brands move into Web3, they may start offering financial services or decentralized infrastructure, such as decentralized exchange, lending platform, even insurance services. But we have also the tokenization of physical assets, and that's what we are doing at Galileo Protocol. Like real estate, art, or commodities could become more mainstream, offering new investment and ownership models that are more accessible and liquid. But the NFT is also about the intellectual property, because brands could evolve the NFT space by linking NFTs to physical products or experiences. Just imagine buying an NFT that is not just a digital collectible, but also a ticket to a live event. And finally, it's about the supply chain management, because utilizing blockchain for traceability and verification in supply chains can just revolutionize how customers understand the origin and the journey of the product they purchase. So that was a fascinating discussion on how major brands are revolutionizing customers' interaction in the Web3 space. From Nike's NFT to Gucci Metaverse ventures, we are entering an area where blockchain and high fashion intersect. But speaking of interaction, we have a development that is creating waves in the financial sectors, and it's too important to overlook. The SEC decision on Grayscale case. You've probably heard of Grayscale, the world's largest crypto funds, and its endeavors to convert its Bitcoin trust into an ETF, a spot ETF. Well, there have been significant developments, and the US Securities of Exchange Commission, what we call the SEC, has decided not to appeal its loss against Grayscale in court, effectively making it more likely for Grayscale Bitcoin Trust, GBTC, to become a spot ETF. And this is a seismic news for not just Grayscale, but for the cryptocurrency market at large. So we have seen a legal battle. And back in August, a DC Circuit Court of Appeals found the SEC denial of Grayscale application to be arbitrary and capricious, and the court ruled that federal agency needs to treat like cases alike. And this happened despite the SEC already approving the trading of 2 Bitcoin future funds, leading to a complicated narrative around their decision-making process. And it has an impact because upon the news, what we saw yesterday is like the Bitcoin price catapulted over 27k, and this spike is a testament to how monumental this decision is for the cryptocurrency market. It brings up the questions on how much regulatory milestone can affect crypto prices and what this means for the mainstream acceptance of cryptocurrency. But what's next? What's next? While the SEC has chosen not to appeal, the future is still not entirely written in stone, and the agency retains the authority to reject Grayscale application on other grounds. But now Grayscale has precedent on its right. Moreover, this decision could possibly pave the way for other entities like BlackRock or Fidelity, who have also filed for a Bitcoin spot ETF. And this development is not just a win for Grayscale, but also an optimistic sign for broader acceptance of cryptocurrency in the financial landscape. It's an exciting time to be monitoring this space at each decision like this has far-reaching implications, not just for investors, but for the financial system as a whole. So how might the SEC decision not to appeal future application future application for cryptocurrency ETF by other company? I think the SEC decision not to appeal could serve as a precedent that influence future consideration for future ETF application by other company, green light for new players, but also a standard settings. I mean, the approved ETF could act as a template for future application, but also encourage legal and regulatory clarity, because lack of an appeal might be seen as a tactic and mission that the legal and the regulatory framework surrounding cryptocurrency is adequate enough to allow for such financial instruments. So, as we are navigating the constantly shifting landscape of cryptocurrency, one development that can be ignored is how traditional sectors are integrating digital assets into their operation. Just when you thought about the crypto world couldn't step further into our daily life, here comes another heavy hitter making in line. And we have talked about the impact on financial markets with the SEC recent decision around Bitcoin ETF. Now let's steer the conversation toward the luxury automotive industry. Hold onto your steering wheels, because this is going to be a fast ride with Ferrari. Reported on October 14th, 2023, Ferrari marketing and commercial chief Enrico Galliera disclosed that the Italian automaker will initially roll out this payments scheme into the United States. And given the substantial interest from its affluent clientele, the company plans to extend this facility to Europe in the near future. So now, why is such a big deal? Well, the majority of blue chip company has been very cautious about accepting cryptocurrency due to their volatile and regulatory uncertainties. And Tesla famously started accepting Bitcoin in 2021, but later halted it, citing environmental concerns. However, Ferrari is taking a different approach. And Galliera said that the effort that has been made in the crypto space to reduce their carbon footprint, aligning with Ferrari's own goals of achieving carbon neutrality by 2030. And this is significant because it suggests that the corporation might be increasingly looking at the eco-friendly advancements in the crypto technology as a green light to join the revolution. Another angle here is the diversification. Galliera points that some of Ferrari's clients are traditional investors looking to diversify their portfolio, while others are young investors who have made fortunes in cryptocurrency. So by accepting digital assets like Bitcoin, Ether, and USDC, Ferrari isn't just accommodating its existing affluent customers, but is also opening doors to a new demographic of wealthy crypto investors. And lastly, let's talk about logistics, because to shield from the volatility of the cryptocurrency, Ferrari has partnered with BitPay, one of the largest cryptocurrency payment processors. And this payment processor will immediately convert cryptocurrency payment into traditional currency, providing a safety net for both dealers and the company. So there you have it. Ferrari is not just speeding on the race track, it's also accelerating its space in the digital financial ecosystem. Whether you are in it for the love of cars or crypto, one thing is clear: the lines between the traditional and the digital finance are blurring and fast. So, do I think that Ferrari's decision will create a domino effect, encouraging other luxury brands to accept cryptocurrency? Well, for starters, this Ferrari we are talking about, a global symbol of luxury, engineering prowess and performance, and this decision to accept cryptocurrency as a form of payment represents a milestone in the adoption of digital assets by traditional industry. It's not just tech startups or disruptors in the finance world. We are talking about a legacy brand that has been around since the beginning of the 20th century, 1939, making a pivot in the digital age. And this move signals a couple of significant things, and what it indicates that cryptocurrency are becoming increasingly accepted and normalized across various sectors. It's not just for trading or investments anymore, it's for buying real, tangible goods, luxury goods. And second, it serves as an endorsement for the stability and utility of cryptocurrencies. If a brand as esteemed as Ferrari is willing to transact in them, it sends a message that these digital assets are not just play money, but a legitimate form of currency. That's a wrap for this edition of Tech Frontiers. From the shocking revelation in Caroline Ellison case to the revival of NFT to proactive involvement of top brands in Web3 and regulatory shift like SEC decision regarding Grayscale, it's been a whirlwind of insights. And not to forget Ferrari crypto revolution in the luxury car market. Thank you for tuning in. I am Pierre Beunardeau and I cannot wait to explore more technological landscape with you in our next episode. Make sure to hit that subscribe button so you don't miss